Silver is the new oil. How the US and China are weaponizing the periodic table. If you think silver is still just a precious metal, here's the gut punch. On January 29, 2026, Reuters reported silver surged to a record high of about 120 yuans or 60 an ounce, and within the same headline cycle, the market turned savage. One of those moves that makes regular people feel like the game is being played in a room they're not allowed into. Verify this yourself. Look at the number, look at the date, and ask why a metal most people never track is suddenly trading like a panic button for the global system. Now zoom in on what happened next. NBC News reported that after President Donald Trump announced he would nominate Kevin Warsh to chair the Federal Reserve, spot silver dropped more than 37% intraday to around $84.63 a troy ounce, an air pocket move that doesn't happen in sleepy, collectible markets. That kind of snap drop is what you see when traders are no longer pricing a commodity. They're pricing power, credibility, and whether supply lines stay open. Public record, public reporting. You don't have to believe me, just read it. So here's the premise of this investigation, stated plainly. In the 20th century, empires were built on oil. In the 21st century, the new empires are being built on the periodic table, on minerals that sit inside everything we call modern life. And silver in 2026 is behaving less like a shiny store of value and more like a strategic material whose price can be yanked by geopolitics, export paperwork, and government stockpiles. The reason to care is not mystical, and it's not a meme. It's supply chains, it's industrial dependence. It's the reality that the modern economy doesn't run on one fuel anymore. It runs on a basket of materials processed through a handful of choke points. And the moment a choke point becomes political, you don't just get volatility, you get leverage. To understand why this looks so familiar, we have to go backward. Because history doesn't repeat, but it absolutely reuses its best tricks. In the 1970s, oil shocks and fuel shortages ripped through economies and forced governments to accept a brutal lesson. If you don't control your emergency supply, someone else can hold you hostage. The International Energy Agency describes how countries came together after the early 1970s oil shock, building emergency stocks to protect against supply disruptions. That stockpile mindset didn't disappear. It went quiet for decades. And now it's back, updated for minerals. That is your historical parallel. Oil was the strategic commodity that could freeze an economy. Today, it's critical minerals, materials that sit inside solar panels, EVs, grid hardware, data centers, drones, and defense systems. You don't need an oil embargo to create pain anymore. You can create pain with export licenses, refining bottlenecks, and restricted processing technology. And here's the part most audiences miss. The battle isn't always about who digs the rock out of the ground. The battle is about who turns it into something usable. The IEA states that for 19 out of 20 strategic minerals, China is the leading refiner with an average market share of around 70%. And for rare earths specifically, China dominates separation and refining at about 91%. That is the midstream choke point where leverage lives. Now we step into February 2026 reality. The Silver Institute, relying on analysis by Metals Focus, says the silver market is expected to remain in deficit for a sixth consecutive year in 2026. That's not a one-off, that's a structural pattern. Their outlook describes a continuing reliance on above-ground inventories, meaning the market keeps solving today's shortage by pulling forward tomorrow's supply. Reuters summarizes the preliminary estimate. A 2026 deficit expected around 67 million ounces, with industrial fabrication forecast around 650 million ounces, physical investment expected to rise to about 227 million ounces, and total supply expected around 1.05 billion ounces, including mine production around 820 million ounces, and recycling rising above 200 million ounces for the first time since 2012. These are numbers that define the backdrop. In this type of market, the risk is simple. Demand keeps leaning on silver across key industrial uses, while supply growth remains incremental, and the gap is filled by draining existing inventories. That's why the price can surge upward, and that's also why the price can collapse when traders get spooked. Tight markets don't absorb shocks, they amplify them. Now we go country by country, USA, UK, Germany, because this is where macro policy meets the real economy. The United States is no longer treating this as just a market story. On February 2nd, 2026, the Export-Import Bank of the United States announced Project Vault, a supply chain security initiative establishing a U.S. strategic critical minerals reserve structured as a public-private partnership intended to store essential raw materials across the country. EXIM states its board approved a direct loan of up to $10 billion to Project Vault, with early indications of participation from major manufacturers, including GE Vernova and Boeing. EXIM's own recap frames Project Vault is backed by a $10 billion EXIM loan and nearly $2 billion in private investment, presenting it as a decentralized approach to strengthen critical mineral supply chains. Reuters reported the same day that Trump announced plans to launch a strategic stockpile of critical minerals, describing a $12 billion initiative with a goal of maintaining a 60-day supply for emergency use. Regardless of political interpretation, the signal is clear. Minerals are being treated as national infrastructure. London matters because it remains a major hub for precious metals trading and storage. The Silver Institute describes continuing physical tightness and a supportive macro backdrop for precious metals prices in 2026, even while volatility remains a persistent feature. In tight markets, liquidity becomes fragile and headlines become accelerants. Now Germany, the industrial heart of Europe. The IEA warns that export controls, licensing delays, and supply concentration create risks for strategic sectors, including automotive, defense, semiconductors, industrial motors, and AI infrastructure. Germany's model is built on advanced manufacturing, which means disruptions in refined inputs or component supply quickly translate into real economy consequences. This is the mechanism often described as strategic leverage. Export controls can now reach downstream goods, parts, and assemblies. The IEA notes that in October 2025, China announced further export controls on rare earth elements and related products, equipment, and technologies, and that from December 1st, 2025, controls could extend to internationally made products containing certain Chinese-sourced materials by value. See set summary of MOFCOM. Notice 2025, number 61, adds another layer, export permits tied to trace Chinese origin rare earth content, described as a threshold of around 0.1% or more by value for certain cases. Rules like this can turn global manufacturing into a compliance challenge, forcing companies to redesign supply chains or wait for approvals that may not arrive quickly. Silver export restrictions also require careful framing. CNBC reported that China is set to tighten controls on silver exports and described how policy discussions formally elevate silver from an ordinary commodity to a strategic material. That characterization comes from reporting and insider commentary, so it remains important to verify official ministry postings directly. Step back and look at what the market itself is signaling. Reuters reported silver's record high at $121.60 on January 29th, and later reporting showed prices around the low $80 range by early February, still elevated year-to-date despite volatility. That combination of extreme highs and violent pullbacks, alongside persistent deficit expectations, suggests a market shaped by both fundamentals and policy risk. This leads into a framework analysts are watching closely. Stage 1 is already visible. A sixth consecutive year of deficit in the silver market is the baseline expectation. Persistent deficits change behavior by encouraging strategic buying and long-term supply agreements. Stage 2 is the export control reality described by the IEA, where licensing risk extends beyond raw materials into technologies and finished components. Stage 3 is the U.S. response, validated by official reporting around Project Vault and the development of strategic reserve structures. Stage 4 is the emerging possibility that silver increasingly trades with a security premium, where price reflects not just industrial demand, but the perceived reliability of access. When markets begin pricing security risk, three patterns tend to appear. First, fast and violent moves tied to policy headlines. Second, increased stockpiling and long-term contracts that quietly tighten spot availability. Third, experimentation with alternative settlement systems, not because any currency collapses overnight, but because geopolitical friction encourages diversification of payment rails. Reuters reported that India's central bank proposed linking BRICS countries' official digital currencies to make cross-border payments easier, while also highlighting the challenges of interoperability and governance. The ambition exists alongside serious obstacles, which reflects how slow structural change can be. So where does that leave us? As of February 2026, the public record shows a silver market expected to run a sixth straight deficit year, ongoing physical tightness, expanding export control frameworks around critical minerals, and a United States policy shift towards strategic stockpiling. Whatever your political view, the direction of travel is visible, and markets tend to react long before consensus forms. In this evolving contest over strategic materials, access and reliability increasingly shape price behavior. Understanding that shift may matter more than predicting any single headline move. And if you want more investigations, built from public reporting and original documents rather than speculation, follow along for future breakdowns as we continue tracking the policies, supply chains, and quiet agreements reshaping the global system.